What we're talking about is something happening. The oil dollar breaks down, and then there's a sharp reversal for short side trading. With speculation ending and inflation boom 2.0, the stock and commodity markets are bullish. It seems interest rates are turning bearish, and bonds should be turning bullish. More on that soon. Of course, the first thing today is, yes, oil. Do you remember last time we talked about what this is? A breakout reversal, right? This is an opportunity, right? But this opportunity was quickly broken, huh? You have to remember to watch the low point of the breakout reversal. If it breaks below that, the consequences can be very serious. We've been trading commodities for a long time, and we've mostly been successful, except for this time with oil. As I mentioned before, you can approach it as a bull market. For example, let's take American commodities. When silver breaks out, that's an opportunity, right? Like this time it broke out here. We've been dealing with commodities for a long time, and we've talked about inflation 2.0. So commodities have surged, and futures commodities have surged as well. Everything has surged. So is there an opportunity here? A breakout is an opportunity, and as long as there's a breakout, your success rate is very high. This is one thing. Wheat is the same. It has reached a satisfying point. But recently, some commodities, including some from mainland China, have dropped quickly after rising high. Next, we talk about oil. If you want to operate efficiently, we've mentioned this before. You must know how to set stop-loss points properly. Your stop-loss point must be based on a very important foundation. Okay, so this turning red originally was just a false breakout. Alright, I often say, sometimes when you are trading stocks, if you are doing very well continuously, just keep doing it until you start losing money. This commodity is oil. You see, why do I say keep doing it until you lose money? Because when you start losing money, it means the trend is starting to reverse. Okay, this is about oil. Talking about oil, oil is one of the commodities and resources we previously mentioned. If it suppresses the price, then the commodity market continues, right? But if it drops significantly back to the starting point, it breaks the line. Breaking the line turns into a bearish right side trade, just like this break, right side trade, and then the stop loss point will appear, which is the neckline. So we often say, sometimes, as we know in the market, generally speaking. Now looking back, it turns out it was a false breakout, right? But you need to recognize it as a false breakout and not be fooled. Sometimes it's normal to jump in and buy, but you must set a stop loss point. If it breaks, you need to get out quickly because oil is weakening. Let's look at this again. We've been in the commodity market for a long time, and every wave has risen well. The only commodities left with opportunities are live hogs and eggs in mainland China, which are relatively low. Try to avoid other commodities, especially those that have risen a lot like gold, silver, copper, and iron. Let's take another look at this. What happens next? That means the probability of the CRB breaking the current level is indeed very high. If it breaks this line, it means oil drives it, and only then will it break out. A breakout indicates that the head formation here, the right side formation, will be more mature. Now, let's look at this again. Let's go back to oil. So we still need to look at its weekly chart in detail, because this time's breakout, this line, sometimes we talk about reversals, right? We mentioned reversals before. Okay, we've been here many times, but this time it's indeed called dangerous because it's a breakdown. This is definitely a breakdown, and there's a fake breakout here. So, what have we talked about in this bull market? It's about pulling up assets, pulling up everything to raise the prices. This includes oil, commodities, all stocks, especially those so-called blue chip stocks. They're all being pulled up. What about those assets? They contributed to the United States GDP this time, didn't they? It was the rise in asset prices that supported this GDP. Now, as this turns weak, let's talk about the US stock market. The high-end volume and price are diverging, and there's a lack of buying power. So, the risk is very high. Commodity prices have already weakened here, driven by US oil. This oil movement has also influenced the CRB, increasing the chances of it weakening. And then, let's look at the US dollar. Because the US dollar is also showing a very significant breakdown in oil prices and a remarkable breakdown in the dollar itself, which indeed creates pressure on the right side, so the dollar is forming a right side bearish trade. Using a right side bearish trade, the weakening of the dollar indicates what I mentioned before, that it's especially time to harvest globally. I've mentioned this before, but I'll say it again. I was going to skip all of this because now today there's really not much time, haha. This is different from your previous perception. What can a strong US dollar get you? In 2022, the US dollar was strong, right? In 2021, it appreciated, they raised the interest rates, and the US dollar appreciated. The US dollar is appreciating, so with a strong dollar, you can exchange it for more foreign currency. Speaking of the dollar, all of this, including Taiwan and Europe, we mentioned Europe and Taiwan, good people, they all raised it. Including Japan, they all raised asset prices. This speculation drove up asset prices, and then you could buy more foreign currency. Now, assuming my logic is correct, it's time for a full-scale harvest. So, devalue the US dollar. And what happens when the US dollar devalues? Foreign currencies can be exchanged for more of their own country's currency. Sigh. This completely breaks the so-called economic theories of the past. If you use the old theories, because of capital inflows, it should logically push up the domestic currency. But my thinking is different from others, just different. Some people with economic fundamentals, like PhDs in economics, often laugh at me, but many of those who take my classes are PhDs in economics. Sigh. Some things, you have to adapt to the times, because each moment is different, Well, there will be some new economic theory emerging in the future, because something must be revised, as this time is very different. Every period, something gets revised. The classical school, the neoclassical school, Keynesian theory, new Keynesian theory, all the old and new ones come up, and every few years it changes. The US dollar, when it weakens, what does that mean? And when prices come down, what does that mean? It means the likelihood of a rate cut increases. So, a rate cut, let's look at this. This is the US 10-year Treasury bond. And the bond, here we also see a right side pullback. So this time, from the bottoming out after breaking the previous low to the false breakout at the top, the 10-year Treasury bond should have a chance to enter the right side. That relatively speaking indeed turns into US Treasury bonds. The bond prices have that interest rate which is falling, so conversely, the prices have a chance to rise significantly higher or increase. Then there's the 2-year Treasury bond, and let me tell you this. We've often talked about the countdown to the yield curve inversion. The end of the inversion indicates the beginning of a long-term downturn. We experienced long-term downturns in the past, so when the inversion starts to shrink, we should see it as the beginning of a new phase. We don't need to wait for the inversion to end. The start of shrinkage is enough to signal a new beginning. This applies to both the 2-year Treasury bond and the 10-year Treasury bond. The inversion of long-term and short-term interest rates will end. This time, the weakening of the US dollar and oil happened on the same day. I need a break. On the same day, the chances of a bearish trend are very high, including in the European stock market, where the chances of turning bearish are also very high.